G'day everyone, it's Michael Beresford here from OpenCorp. For the October update, powered by OpenCorp's research team. I'm going to give the guys a bit of exposure here. So, look, over the last 12 to 18 months, we've seen the media, news reports, newspapers dominated by a few key topics. Early on, it was obviously price growth, especially in Sydney and to a lesser degree in Melbourne. Does that mean there's a bubble? Interest rate movements, negative gearing around the election time. More recently, how much tougher the lending environment is as a result of APRA's constraints. But I've noticed there's a real shift in terms of what we're seeing, and it's almost like the property market has disappeared off the face of the earth with respect to the popular media of late. There's nothing like a few politicians that are dual citizens to throw something into the mix and take property off the front page. But it's been a really noticeable thing where really the only article of substance that I've seen in the last couple of weeks around property was the fact that Sydney had gone backwards in the last quarter. Now, there's a hint of sarcasm in my voice. Over the previous quarter, the median house price in Sydney dropped by 0.1%. Okay, so let's call a spade and say that it held flat. But nothing like that to get the headlines out. So I guess in essence, what we're seeing is everyone just starting to get comfortable with a lot of the topics that have gone out there. And I guess the takeaway point for all of us as investors or interested investors is just remember, with white noise, whether it be the media, newspaper, friends, family, whatever it might be, all those potential distractions to stop you from building a successful portfolio, that people do get comfortable with things. Certain topics have their airtime and then life moves on, and journalists do the same. What is particularly relevant though, and I am going to focus on a common topic we've been talking about over the last 6 months, is the lending landscape right now. Without doubt, it is the number one question we get asked about by people wanting to be able to invest and improve their borrowing capacity, but just not sure how to do it. In short, it's tough. In my 15 odd years of being involved with property and investing in it personally, it's about as hard as I've seen it, on par with right after the GFC, when the lending pot shrunk dramatically in terms of the available funds to borrowers through the banks. It's basically what the global financial crisis was. So rest assured, if you are having challenges, then I don't see it getting much tougher than what it is today. It's pretty tough. But as a quick recap, there were two key guidelines that APRA wanted to impose upon the banks. The first was that they wanted them to reduce the percentage of interest-only loans on their books to a maximum of 30%. The second thing that they wanted to do was to reduce year-on-year growth of investment lending or interest-only loans to 10% per annum. And there have been a few reports coming out from various conversations with brokers and the financial community that 30% threshold has been achieved by a few lenders in recent weeks. So safe to say that those APRA constraints are having the desired effect, and the risk being reduced in their eyes by having more loans as a percentage of the loan book being principal and interest, and actually reducing a bit of debt at the same time. So that's the positive. Obviously, what it's meant for interest-only investors is that the rates have gone up. While negative gearing's in place and there's tax deductibility on that interest, not a material difference to the holding cost. But let's understand the bank's motivation there, and the fact that most people are motivated to choose their lending product primarily based on where they can get the lowest rate. So if a principal and interest loan has a much lower rate compared to an interest-only loan, then that's in their eyes going to be a good carrot to dangle in front of a borrower. It had the desired effect, but in essence, generally those principal and interest loans will still cost slightly more on a week-to-week basis when holding your investment property. Regardless, if we're moving towards a safer lending environment and there is robustness around what's happening in the lending market, it just reduces our risk against downturn, reduces our risk against financial crisis, and for those of us that hold substantial hundreds of thousands or millions of dollars of worth of property assets, gives us a great deal of confidence that lending market is quite secure and strong. So that's the upside. In terms of where we see the markets at this point in time, the State of the States report, if we're focusing on the four key capital cities, Sydney, Melbourne, Brisbane, Perth. I'm going to focus on those in varying levels of detail in the summary today. Sydney, been on a major growth curve since 2013 or thereabouts. We believe whether it's at the very top of the market or pretty close to, it's close enough to the top of the market that we wouldn't be investing in Sydney. So as much as I love Sydney as a place, sorry Sydney-siders, Sydney market's done some amazing things, made everyone a lot of money. You should be looking to take that equity and invest elsewhere. We wouldn't be looking at Sydney at this point in time. Brings us to Melbourne. Really, this is a call to action for anyone that doesn't have an investment property in Melbourne, been thinking about it. The chance is really running out to be able to acquire a good quality investment property at the right price in Melbourne. What I mean is, with the growth that we've seen, and the majority of that growth actually coming in the middle ring growth suburbs of late, the prices have increased, but rents obviously haven't kept pace with the rapid price growth that we've seen. So from a holding cost perspective, it's not unusual in certain pockets of Melbourne to see prices somewhere between $570,000 and $620,000, still achieving rents of $400 to $420 per week. Now Melbourne is well known and has I guess a track record of having slightly lower rental yields than some of the other capital cities, but still, that means that assuming an average income and tax benefits associated with that, the holding cost really is getting up towards $120, $130, maybe even $150 per week. And when you look at the alternative, really the alternative can be more appealing in terms of being able to hold 2 or 3 properties for that same amount of cash flow. So we don't think the Melbourne market has run its race just yet. Still got some growth to move, still got some catching up to Sydney to do. The fundamentals are strong, and I'll cover those in a second. But call to action to all of those potential investors in Melbourne. If you don't have any exposure in the Melbourne market, now would be a really good time to be able to acquire property in Melbourne. Why is the Melbourne market performing so well at present? And why do we still see that it's still got some room to move? Basically, it comes down to 2 things: jobs and population growth. So Melbourne is getting the majority of the population growth within Australia of any of the 4 capital cities right now. That's pretty well reported. I won't go any further into that. What I will cover is some recent jobs data that came out that said, from the ABS and the Productivity Commission, talked about the fact that 240,000 jobs had been created in Australia last financial year. That's a massive number. And what you might not be aware of is that 80% of those jobs were actually full-time jobs. Okay, so there's been a lot of talk lately about a transition to more part-time work and so forth. But approaching 200,000 full-time jobs created in Australia last year. Of that job creation, about 80% of those are happening in Melbourne. So again, no surprise based on the primary core dynamic we talk about, supply and demand, as to why the Melbourne market has been amazing. Let's get on to Brisbane. Brisbane is, in my opinion, probably the pick of the bunch right now, and it's very simple to explain why. We talk about how markets cycle, and we talk about historically the fact that Sydney starts a cycle, Melbourne follows, Brisbane follows Melbourne, and Perth follows Brisbane. If we look at the last major growth cycle before the current one in Sydney and Melbourne, Sydney grew substantially, upwards of 80% between 1998 and 2002. Melbourne had its go between 99 and 03, Brisbane 2001 to 2004, and Perth 2004 to 2007. So keeping that in perspective, it wasn't surprising that Sydney started to see growth in 2013 because it basically had 11 years on the sidelines. And that's historically how cycles work. So we see there's a period of rapid growth that's followed by a correction and then stagnation where prices don't move for a while. And that's exactly what we've seen in Sydney. So in terms of what that means for Brisbane, well, in essence, there are 2 key metrics we're looking at Brisbane right now. The first is the median house price. In short, the last time that the median house price gap between Sydney and Brisbane was so great was back in 2001. Okay? Sydney median house price today over $1 million, Brisbane tracking around $550,000. Massive difference there. The second thing is that in the last 12 months, net interstate migration to Brisbane is up 80%. And the last time it was that high, again, was in 2001. And if we go back to what I said just about before, 2001 to 2004, the Brisbane median house price grew over 100%. It more than doubled in a 3-year period. Okay. So we see the Brisbane market as having massive opportunity at this point. If numbers aren't your go and you need a simple explanation, try this for size. There's nothing stopping somebody in Sydney selling a house for $1.1 or $1.2 million, buying the equivalent really nice property in Brisbane for around 600, 650, moving, provided there's a job for them to go to, and pocketing about 500 grand after costs in the process. That's going to have some appeal, and why net interstate migration is so important. So big tick for Brisbane. Brings us to Perth. I've actually just got back from a couple of days in Perth with our acquisitions team, and we're looking far more seriously at Perth now as an investment option. Reason being is that there are two key criteria that have been red flags to us in Perth in recent months and years, and that's been the vacancy rate and the unemployment rate. The vacancy rate has been on a steady decline since January this year, and from an unemployment perspective, 12 months ago, the Perth's unemployment rate was at 6.5%. That subsequently dropped to about 5.6% at the end of the financial year. That made it the second lowest unemployment rate amongst the 4 main capital cities. And since then, it's further reduced to 5.4%. So given that jobs are the fundamental that drives most of the markets, we're really starting to see a pickup in Perth in the metrics that are important there. What does that mean for the market and the opportunities itself? Look, we still think that Perth's probably 12 to 18 months away from a full-blown recovery, and that's the information that we're getting on the ground from developers and the like. But a key development that we learned about is that Westfields have actually been sitting on a development approval for a major shopping centre and entertainment precinct project in Perth for the last couple of years. It just wasn't the right timing for them to bring that to market. They've now started to commence development works on that project right now. So understanding the timeframes to bring that to market, they're seeing the same kind of things that we're doing. OpenCorp are proud of our track record, but Frank Lowy and the team at Westfield, they've got a pretty good track record over the years as well. He's in the top 5 richest Australians year on year. So that's a really big key indicator for us. The opportunity at Perth, though, even though we think it's 12 to 18 months from seeing any major growth, where the opportunity does exist is that prices are so affordable. And because there are builders in the market that have basically been reducing their margins to stay in business and continue to do some building work, in essence, we're able to buy under market value, because when the Perth market moves, historically it moves very quickly. And what that means is that as soon as trades and everyone in the construction industry becomes in higher demand and the cost of materials increases, we see steep increases in the build price very, very quickly. So while we might not see growth for 12 to 18 months, the opportunity in Perth is to be in at a basement level, be able to basically make some instant equity by being able to buy the fund the build at a much cheaper cost than what we would otherwise expect in a moving market, and then be able to ride the wave of growth whenever it does start through what's generally a fairly good growth period of 3 years or so in every Perth boom cycle. So there we go, guys. Fair bit of detail and a fair bit of data for you. That's how we're seeing the 4 key markets right now, in addition to some latest updates in terms of what's in the media and the popular press about property. Hope you found it insightful. We look forward to seeing you next time. Bye for now.